Good evening, everyone. Tonight we have the pleasure of having our expert trading coach, Mr. Gordon Scott, back with us. And Gordon has been an active investor for nearly 20 years and has coached for more than a decade. So, Gordon, welcome to the Candlestick Forum. We look forward to your presentation tonight.
Thank you very much, Becky. It's an honor to be here, and I just want to tell everybody welcome. I hope that you will come away from this presentation tonight with some information to enhance your study of Stephen's candlestick techniques and the things that you're learning with the Candlestick Forum. We have some interesting information to present to you. When we coach Candlestick Forum students, sometimes we come up with common themes and common questions. Just the other day I got a call from somebody who said, my 401k is down, like 20% here just with this last week's hit. What do I do to repair it? Is it too late? Well, the biggest and most important thing to understand about a rapid change in the markets is that represents kind of a crisis. And with every crisis, there is an opportunity. But knowing how the game has changed, knowing where the opportunities are, that's a bit of a trick, but that's what coaches are there for. That's what they're able to tell you, okay, wait, new game plan. We have to adjust. It's halftime, we have to adjust, right? To use the sports metaphor. I'm not going to be too heavy on the sports metaphors tonight. We are going to be very heavy in the market information tonight, though. And when crisis meets opportunity is now. That is to say, we're going to be in a market for the next little while with increasing volatility. And so you need to be better prepared to take advantage of market conditions that are different from the way they've been over the previous part of 2015, and in fact, going all the way back to 2009. So I will present this evening, and then just afterwards, Joseph Anderson, who helps our students figure out how they want to improve their education, will be presenting right after me. He's got some very worthwhile things to tell you about there. And I want to just get started with how to invest during and after crises hit, but let's start it off with these tactical principles. This is the framework for how to recognize where the opportunity is. Investors naturally fear what they don't know. Okay, that's a big and important principle, because that means the more uncertainty there is in the market, naturally, the more fear enters into the market. It's not because of things that they do know that are going to happen, or that bad things are. If a company has accounting fraud, that's a bad thing. Once that's understood, this company has accounting fraud, that's not what makes the stock keep going down in a downtrend. The stock will adjust to whatever they think the bad is. But what makes a downward trend and keeps it going down for a long period of time is the uncertainty. Okay, we know there's fraud, but what do we not know? How bad is this? How much worse are the next things that are going to come out? How much fraud is there? If they'll lie about a little, is there a whole lot? It's the uncertainty factor which creates the downward trend. One big drop in a single day, once a bad news item comes out and the stock adjusts fairly instantly, in a matter of minutes, that's it. News is out. Price is factored in. That's not what drives. It's the fear of the unknown. So when the unknown happens, when there's this great sense of things that people don't know, investors naturally overestimate. You think about it, when you, as a human being, go into a situation where you don't know what's going on, you try to think of everything about you and around you that could possibly go wrong. Not that it all will go wrong. Maybe only a couple of the things will go wrong, but there's 10 things that could go wrong. My daughters just started school this past week, and one of them is her first year of high school. You know, talk about one of those moments where you're trying to prepare for everything, right? And she was worried about a dozen things that could somehow be bad. I won't like my classes, and my friends won't be there. I won't make new friends. I don't know who I'll sit next to at lunch. Is my hair okay? And on down the list. And she comes home, and there was one thing that went wrong, something about a book and a text in a class, but everything else was fine. That moment, however, where she was thinking of all the dozen things that could go wrong, at that moment, your brain plays Murphy's Law game. Anything that can go wrong will go wrong. Wow, I got to get prepared. What am I going to do if all does that? We're human beings. We naturally have that inclination. If we don't naturally have that inclination, we get hit by something when we're young. But you get the idea. So investors naturally calm down once they believe they know enough, once the unknown moves into the known. That's when the calming down starts. And then, once we realize that whatever the investors believe, do I know enough or do I not know enough? That's the most useful gauge of their future actions. If investors feel like there's more unknown out there, we can expect that investors in that particular area are going to send prices lower. If we can tell that somehow investors feel like they've got a handle on it, they're going to send prices higher. Those are our tactical principles that we can operate under when doing crisis investing. All right, so how do we tell? In the case of stocks, and this actually applies to a variety of things, but most specifically it works with the S&P 500. The volatility index for the S&P 500, more commonly known as the VIX, is our gauge of how much fear there is out there, or in other words, how much people don't know. So the SIBO publishes it, and it's a heavy-duty math formula built on option transaction volume. It measures the amount of protection investors believe that they need. The VIX formula can be applied to any liquid instrument that also has options and futures. So, if you were to type in the ticker symbol GVZ, I think it is, then you get the VIX for gold. If you put in VXFXI, assuming that your platform has that ticker symbol available, you'll get the VIX for the Chinese market. If you put in VXN, you get the VIX for the NASDAQ, and so on. They're beginning to apply VIX to a lot more indexes, and it's a great thing. But the most liquid options, the place wherever the most liquid options are, that's where you're going to find the most validity to the VIX formula, and that still remains S&P 500. So if we look particularly at that, then we actually get a better idea of how to gauge crises, regardless of whatever asset we're looking at. So how do you read the VIX? Well, VIX movement can tell you what investors believe in summary. And a change in the VIX price movement signals a change in belief, and that's the key. Once we see, oh, they're afraid, they're worried about a lot of things they don't know. And look right here, we begin to see now they feel like they know, they got a handle on it, and the fear is decreasing. The VIX peaks can tell you when the fear is beginning to decline, and the VIX trend tells you when to expect that the crisis might be over. Just the whole trend of the VIX. If it's trending up, it's not going to be over in the near future. Once it flips and goes the other way, it could be over soon. So let's look at a couple of examples of this. The most famous example, of course, back in 2008, market drops nearly 50%. And what does the VIX do? Well, notice here that the VIX has this sort of, fast movement up. I mean, people were so afraid in 2008 that the entire financial system was going to collapse. I mean, good heavens, Lehman Brothers went default. Are you kidding? Lehman Brothers. And Bear Stearns was already gone. I mean, these sacred cows are slain. And, Morgan Stanley gets bought by Barclays or Mitsubishi, I can't remember which, now all of a sudden. And Merrill Lynch gets bought by, quote unquote, right, by Bank of America. So anyway, all of these major investment banks, which seemed like the pillars of Wall Street, are all poof, gone in an instant, and Goldman Sachs alone remains. And so at this point, people are worried the entire financial system is going to collapse. And that's why the VIX jumped to unprecedented levels. Because, well, if one of these is gone, if 2 or 3 or 4 out of the 5 are gone, then who knows how bad things really are. That's the sort of mindset that everybody was in. But shortly thereafter, November and December of 2008, the peaks began to decrease. And then the trend, instead of this wild uptrend, became a downtrend by the end of the year. Now, the price still, S&P 500 was still heading lower even into 2009. January and February were down months. And as they went down, the VIX went up a little bit more, but it was a much lower peak. Well, knowing the tactical principles that we just explained, can you see how simple this was for us to recognize that, fear has abated. We've hit a new low, and people are still nervous, but they're not nearly as nervous. Good chance that the end of the downtrend is somewhere right around here. And so then, when the market starts heading back up in April and May, you can feel confident in trying to test the waters. The real kicker, notice this. See this low right here? Once that low gets taken out, right there at the beginning of April, and it makes a new low before turning back up, I mean, that's it. That's okay. That is the lower high, lower low trend, and we can expect that the market will go higher from here, and boy, did it ever. So that's the classic example. Most markets are not so simple and easy to read, but we start with this easy to read one so that you get the pattern in mind. And don't worry, we will get to where we are today. Just last year, we had an interesting little example here. This is another little more subtle clue of what you can find in the VIX. Okay, so the VIX, in this case, is the black candle chart, and the S&P 500 is the red line chart in this one. It was the other way around in the previous one. Okay, we wanted to show you how the shape of the candles goes on the VIX. When the VIX, when prices dip down, the VIX index runs up really fast. And it doesn't stay up there. It runs way up and comes right back down. Some people look at this and they say, wow, I want to trade the VIX. VIX is around 12 here and around 40 up there. I mean, just here in a month, kaboom, it triples in value. And hey, just a couple of weeks ago, it tripled in only 3 days. That is really, really tricky stuff to try and time the VIX perfectly. Most people that do it don't, or I should say that attempt it, don't end up doing so well. Trying to time the VIX precisely, like buy here and sell there, that's not a high probability bet. But what you can do is you could say, I'm going to buy the VIX because I think it's going higher. And then once it breaks a new high, just take your profit. Don't try to grab the whole thing of it. Just grab some of it. that's reasonable as long as you get it low enough. I mean, if you got it way back here and you had to hold on forever, and then it jumps up and you take a little bit, or it jumps up here and you take a little bit, but don't get greedy, right? But you can't, when it runs up and makes a new high, trying to grab that and hope it goes higher, you never know. The trading the VIX itself is not your big opportunity. The big opportunity for crisis investing is actually on the index. Once you can see that the VIX is telling everybody that the fear has hit its peak and is abating out of the market. In 2014, the big opportunity was right here. When we see this old high and the VIX runs way up and then in just a few days runs all the way back down to its old high, even though it comes down and then makes this bullish engulfing right afterwards, that's just telling you it's on its way to another peak, but likely not as high a peak as that one. So this is the very earliest indication that the VIX is telling you the fear is dissipating out of the market, out of investors already. Investors are beginning to feel like they got a handle on whatever they were worried about before. And it might be Greece, it might be interest rates, what the Fed's going to do, it might be something political, it might be something economic, it might be weather, it could be anything. But the gist of it is, as the worry is just getting formed, there are many unknowns. As people study and read and think about it, then the unknowns become fewer in number and more imaginable to what the actual likely outcome is going to be. And at that moment, that's when prices start rebounding. So we had this S&P 500 dropped really hard, and all of a sudden it starts going back up again. And in October 15th of 2014, a couple of days after that, the prices jumped up pretty fast, but there was still lots of trade after that as the index ran up and made a brand new high through the rest of the year, and then it slowly continued up for the next 2 or 3 months. So buying right off of that dip, even if you didn't get the very bottom, first 2 or 3 days after, still a fabulous entry point. That's the big opportunity. All right, so that one was just recent. That was just a year ago. There's also China. Now this is going on right now with China. China is both an opportunity and a warning. So here we saw China, this is kind of a counterexample of what I was just showing you, how when you get a lower peak, that's where you think fear is kind of going out of the market. People are like, okay, fine. So this is the VIX of the Chinese market, and this is the Chinese market here on these little candles. And the VIX on the Chinese market ran way up as the market dropped down pretty hard, and this was a couple of months ago. And then as it came back down and made not quite the same low price, but pretty close to it, the VIX wasn't anywhere near the peak. So you'd look at this and you'd say, this is it. This is the place to get in. Well, it won't always be that way. It's not a perfect indicator. It's better than 50%. The VIX is generally kind of new, so we don't have a whole lot of crises to go after. And this is actually the first time that we've had a VIX applied to the Chinese market. But it's important to understand this as a strategy. If you're buying here and the price breaks a new low, well, you just have a stop and you're out right there. See, that's nothing. I mean, you're losing a very little bit. Nobody likes to lose, but compared to what you gain if this thing rebounds and heads back up to its old highs, right? That the win-loss ratio is gigantic. And that's why even when you see a thing like this, you get prepared to give it a try, and just don't worry if you get it wrong. You might have to try it 2 or 3 times. If it works once, you'll have it. Now, look where we are. We're at a much higher peak because, well, it broke through, right? Now, I don't have time to go into it, but if you work with one of our coaches, then they could even tell you how to avoid what signals to recognize. to avoid even making this attempt. So I was like, don't do that. Wait for another one because it's likely to go lower, and then give it a try down here. Well, look at where we are right now. So now this was captured yesterday. Today's data is not on here, and today's data, it actually kind of came down a little bit. So we actually have a lower peak here, and in theory, this might be a place where we could expect to see some opportunity in the Chinese market. If you were to buy FXI, and this was the new high, or sorry, the new higher low, and then it ran back up to its old highs, and VIX started coming down, that could be a really big opportunity for the Chinese market. Now, I'm not suggesting that that's what you should do and that that's what it is and that's how it will happen. I'm just saying that I'm looking at the VIX and it could happen that way. But tomorrow is non-farm payroll report, and that doesn't happen during the Chinese market. That happens just before the U.S. market opens. There's a very good chance that somehow that news will make investors nervous, make them worry about things they don't know, and will gap the market lower tomorrow. And if it gaps the market lower in the U.S. tomorrow, and the Chinese market falls with it, then that could establish new lows, and we wouldn't want that. So that's something you got to watch out for. Don't go just saying, "Wow, Gordon told us about this great opportunity, and we need to get in FXI." No. It's something to watch for. It really is, because there could be this really cool opportunity in just the next few days, just right after Labor Day. We might come back and find the Chinese market has got some serious opportunity in it. There's a lot to worry about in the Chinese market, and the Chinese officials are kind of new to this game, and they don't have it all figured out yet. So it's kind of a long shot. But if it were to be a good opportunity, what you're going to see is that VXFXI, that's what this ticker symbol is there. I'm going to type that in to the chat, VXFXI. And so you can capture that and go looking for it in whatever trading platform you have. And if it makes a lower peak and then starts coming down, and especially if it gets below this low, right, and all of a sudden starts trending lower, that's it. That's your signal. Okay, so that's China. Now we've looked at two past attempts in the S&P 500, and we've looked at current China. Now let's look at the S&P 500 and the current VIX. So this is an interesting little chart because it has the S&P 500 in the gray in the background and the VIX in the color in the foreground. So what we see here is just that it's the VIX and the S&P are mirror opposites. See how that one goes down, the other goes up, right? And when you get them doing different things, then you pay attention. See, so here's SPY coming way down like this, then coming all the way back up, and here's the VIX jumping way up and coming back down. Notice here that what we have is SPY, and this was as of yesterday or the day before, and you see how this candle doesn't look anything like this candle, right? That's important. Let me just look here. Yeah, there's a gap there. There's just not too much gaps. I think this is actually SPX and not SPY. If you use SPY, then you would see a gap here. SPX leaves out the gap. So, but even so, SPY differed from the VIX on this day, and that's important because if there's something different going on, then you have to interpret what that means. And usually, whatever the VIX is doing is the indicator of how investors are feeling. So if this big down day happens, then what we should have on the VIX is this huge up day. Think of the VIX as the fear indicator. Fear would be rising as prices are falling. Here we have prices falling, but fear is not going anywhere. What does that tell you? Well, that should tell you opportunity ahead, because investors are saying, we got a handle on this. We don't need to go buying crazy put option insurance to protect ourselves from downward prices. Yeah, I know we got some downward prices, but they're probably not going to go down too much more insurance would be a waste of time. Why anybody but knows that or believes that, the chart doesn't tell us. But we look at it and we say, they're not putting their money where their mouth is if what they're saying is, I'm afraid. Because if these prices mean fear, well, then why aren't you doing anything about it, right? We just look at that, and that anomaly tells us there's probably a better likelihood that prices will turn around and head back up. And in fact, they did on this one here over the past day or two. Now, there's one other indicator that if I got just another minute or two to share with you, I wrote about this and shared it with all of the colleagues on the Candlestick Forum coaching team so that they can tell you about it. Is a very simple indicator. This helps us recognize longer-term possibilities for crisis markets, bear markets. And the indicators are this. If you take the S&P 500, which is the sort of light gray line here, sorry for the light colors, and you compare it to the utility sector, which is the red line here on this chart. If you see the utility sector doing better than the S&P 500 for 2 consecutive months, and if at the same time that's happening, you see the average true range of the S&P 500 rising for those same consecutive 2 months, that means 2 things are happening. It means, number one, people are moving money, not just people, but professional investors. Investors that run long-only mutual funds. I say long-only, it means they're not allowed to short the stock, they're not allowed to buy options or futures. They got to keep their money in shares somehow. And so when these guys know the market's going down and they know they've got to move their money to safety, they don't like to just let it ride. And they can't move it to cash. They have rules. There's only a certain amount that they can put in cash. So the only place they have to go are safe haven stocks. Well, the safest haven stocks they know are utilities, because utilities pay dividends and their prices are not as volatile as normal stocks. They have low betas, another way to say that. And so over the years, over the past 100 years, if you go back and look, these conditions that I'm describing occur right before a bear market, a 12-month bear market, 90% of the time. Yeah, that's right. 9 out of 10 times you will see this tell. And it's simple to explain why, because what makes the bear market is this long trend of people worrying that things could get worse, professional investors worrying that things could get worse and that they need to move their money out of regular stocks and into safe haven stocks. And if they do it for 2 whole months, and at the same time price volatility starts jumping, as indicated by the average true range, if those 2 things happen for 2 consecutive months, so much so that the price of the S&P 500 dips below its 12-month moving average, then you have a very high likelihood that a bear market is coming within the next 12 months. Well, my friends, that indicator just tripped this past week. I tracked this indicator from calendar month, and as of September 1st, this is how it looks. As you can see, the first month, S&P was going up. First month of these 2, this is July, but the utilities were going up more. And then in August, S&P was going down, but utilities, although they were going down, they weren't going down as much. So that's 2 months of the utilities doing better than the market, and at the same time, the average true range of the market was increasing, and prices fell below the 12-month moving average. I don't know for sure that in the next 12 months we're going to have a bearish market. By bear market, I mean 20% drop from whatever the highest point of the market was. If this was it, then 20% lower from here somewhere during the next 12 months. Might be in 1 month, might be in 11, I don't know. 20% or more lower than that. That's what I mean by bear market, okay? And so this indicator is something I use to say, gosh, I got to watch out for this. Now, right now, we're watching the VIX kind of abate, kind of, the fear looks like it's, sorry, I went the wrong way. The fear looks like it's kind of maybe beginning to come out of the market. Well, that's okay. The market could still go up and make a new high before it goes down and starts its bear market move. Or it might not make a bear market move at all. However, I think that there's such a high chance that the environment that we're in could cause a serious pullback in the market, particularly during the month of November. Okay, I don't have time to explain why that is right now. You'll want to talk to a coach over the phone and find out about that. But that's a very high possibility. And so you want to be on your guard. You want to learn how to plan for those opportunities. So it's true, 2015 may still hold big opportunity. There might be a big run-up in between now and November, up from where we've dipped down up to brand new highs. And then if you could somehow be prepared for it, anticipating it, you could grab somewhere from that new high all the way down to an even lower low than we've had so far. That would be a really big, really fast move, a very profitable one if you were, trading on the short side, trading inverse funds or something. The China correction may also continue, but it's also possible that we're going to find a bottom here somewhere, and that could be a really big jump. So, playing the upside or the downside of the China market, either one is going to be an interesting opportunity. The U.S. stock market is likely to have a bear market sometime in the next 12 months. It may not, but the likelihood is greater that it will, according to that indicator. But either way, the VIX indicator will tell us when the changes come and when it's done. Meanwhile, during a crisis, money has to go somewhere. If it comes out of stocks, it goes into something else. Even if that something else is just cash, it often goes to bonds. It might go to utility stocks. So we can watch for the winners. ETFs that would track bonds are TLT. And metals are another place. Sometimes people feel like, gold is the only safe haven right now. I got to tell you, there's nothing intrinsic about gold as being a safe haven. People shouldn't treat it like that. Some people like to think, when the rest of the world has to deflate their currencies, then surely gold prices will go up. Hey, if the past 2 years haven't taught you that that is not an automatic, nothing will. Don't think of it that way. Look at gold just like any other stock and any other trend and say, what's it doing? If it looks like it's starting to work opposite of all the others, great, then I can trade it. But if it doesn't seem to, it ought to be going up, everything else going down, why isn't gold just flying up? If it's not, stand back. Don't tell yourself, it will soon. Forget it. If it will, it would have already. Oil, either going down a whole lot farther or turning around and popping back up. Energy showed a big spark and a spike in price this last week. And basic material stocks, check out the aluminum market. There's all sorts of really interesting things going on there. If, in fact, we're going to have a rebound in the market, I think that sector is probably going to lead us out just for the next month or so, up until we get to October. Now, if you're trying to capture the downside, then the inverse funds are the way to go. Something like SQQQ and SPXL, these are 3 times leveraged, though, so you got to be careful. These are just for, the whole thing when you're going and trying to get stuff on the downside of the market, you don't want to try and ride it all the way down. You just want to get a little bit. Because it's better than cash, right? If you run up and then you get yourself to cash and the market starts falling 20%, but because you're in cash you don't go anywhere, then when it starts rebounding, because you're watching the VIX, you can tell, fear's going out. Now time to get in, right? Well, you're 20% ahead of the market. And meanwhile, if you just, as it's going down, you capture a little bit, say 5%, right? Then you're now 25% ahead of the market. That's a gigantic win. You don't have to capture every single tick up and every single tick down, and the attempt to do so often puts you worse off than you would be if you were not just simply trying to catch small pieces. Utility stocks, this is what the big guys do. They just put their stocks, their money in stocks that pay a nice dividend and have a stable price move. And then there's one alternative you won't hear anybody else tell you about, but in crisis opportunity, it's really an interesting one, and that is high dividend paying stocks. If you find a stock that has a high dividend, but it also has a volatile price, that can be a real opportunity, because if we hit the bottom and you see the VIX do its little dance of lower peaks, and you think, oh, we might be coming up now. Well, you grab a stock that pays a high dividend, 8% a year or higher. That's a great deal, because if it's going to start from a super low point and it's going to increase by, half again or double its price just because of the market action, and meanwhile it's paying a dividend along the way, you got the best of both worlds, right? I'm going to show you one of those stocks in just a second. Here it is. So there's lots of them out there, all right? But if you don't know where to look, you can start with this one and then research it and find other stocks like it. This stock is Fifth Street Capital, FCS. And what they are is a secondary lender. They try to take small businesses. I don't mean a mom and pop taco stand. I mean a business that, might have 500 employees. And they want to turn it into a medium-sized business that has 5,000 employees, or maybe it's got 1,000 employees and they want to take it to 10 or 20,000, or you've got a restaurant that's maybe got 10 chains and they want to take it to a nationwide franchise system, right? That's what these guys do. They try to find those kinds of businesses, and the nice thing about it is you don't have to get involved in all that they are doing. All you got to do is buy the stock and you participate in their business, because they pay out a dividend every month. And that dividend is typically 1% each month. So it's 12% over the course of a year. Not too shabby. Now, the downside is it's a volatile price. So this was $9 a year ago, and it's sitting at $6. Well, 6 and change. The good news is that it seems like we've got some support here. So if the market is about to go up, this stock could be a great opportunity for someone who, every month you hold it, you get kind of a 1% kickback on your purchase price, so to speak. So if after a year of holding it, it's down 12%, no problem. You've got that money paid back to you. See, that's the idea with a high dividend stock. You got to go into it with eyes wide open, because the reality is if you bought it here and it went and made a lower price at below $6, well, you wouldn't want it anyway. But I think you understand the theory now. Yeah. So, quick question. Carl Icahn stake in FCX recently a sign that metals bear market is likely to end very soon. Don't I agree? I thought it should have ended already. The fact that it hasn't has me a little concerned. So that's I'm being overly cautious and patient. But basic materials really did jump this past week. So maybe, in fact, it's all done there. All right, well, if you're going to play the opposite side, the short side of the market, if you want to profit from things going down, this little ETF, TZA, this is the triple side of the triple inverse leveraged Russell 2000. So if the Russell 2000 goes down 1%, this thing goes up 3%. Now you want to swing trade this if you're going to. See how from here to here, that's a really good trade. You don't necessarily have to get all of it, just capture some in the middle and be done, right? And if you get lucky and you time it right before the big drop, then you get a trade like this. But don't try to use TZA for a long period of time. You should never be in this stock for more than 2 months because the mathematics of it deteriorate the price away. It is not a long-term buy and hold kind of stock. If you think the whole year is going to be a bear market, you would be tempted to just say, hey, I'm going to put my money here and just let it ride. No, bad idea. Do not do that. If you're going to use TZA or SQQQ or any of these, inverse leverage funds, they're short-term trades, no longer than a month, 2 max. And if you're in it 2 months, you better have called the top and ridden all the way to whatever bottom there is 2 months later. Because if it goes up and down, every time it fluctuates up and down, the math sort of resets and you lose a tiny little bit of value. You won't notice it for a couple of months, but after 3 months, you'll really notice it. So just know that about TZ. It's better to try to target, something about a month or less, maybe even a couple of weeks. Personally, I like to trade it just for 3 or 4 days. Try to, grab little moves like that. All right. Well, yeah, SQQQ had some really funky math. It ran way up and way back down. I was very fortunate using the same techniques that I've shown you here. I actually made a trade that entered here. I didn't know it was going to do this. I just thought, okay, well, it's time to swing trade, just like one of these things, right? So I got in here, and 3 days later, I got out. Well, I actually got out right there. I would have loved to have got out here, but for anybody that was watching the markets that morning, it was the morning Dow was down 1,000 points. It was just really squirrely right at the open. The quotes weren't coming in clear, and best I could tell, that was the time to get out. Well, and it was. That worked out to be really good. But I mean, that's one of the better counter trend trades I've ever made. I mean, you look at this and think, wow, I'd love to be able to do that every time. No. You don't get to do that every time. You shouldn't plan on trying to do that every time. You just simply take a small shot, hope for a little. Sometimes you get lucky. But trying to get it perfectly is not the deal here. Making sure that you know here not to be in anything long, not to be in anything trying to be bullish, not buying and holding on to stocks at this point. That's the whole idea. And your coaches can help you with that. So most successful traders say the difference between success and failure is having a solid plan to follow. Individuals prone to emotion make lousy traders. If you think about it that way, then you realize that you make your money when you prepare, not when you trade. So how would you get prepared? Well, that's why we have a guy like Joseph Anderson along here tell you a little bit about how with Candlestick Forum coaching, we help people get prepared. So I'm going to turn some time over to Joseph. Joseph, go ahead when you're ready.
Hey, thank you, Gordon, and good evening, everyone. My name is Joseph Anderson. I am the Program Director for Stephen Bigelow's Candlestick Forum Coaching Department. And the reason I've been asked to come on, and I just want to take really just a couple of minutes, but we're in the process of looking for students who are interested in getting more information on working with one of our coaches one-on-one. Gordon Scott, who you've just heard from, is one of our 5 coaches that we have here at Candlestick Forum, and periodically we'll go through an interview process, and as students graduate from the program, we find students to replace their spot in the coaching. It's a small program, but it's one that we find that if there's a good fit with the student and with the coach, it's very effective. The reason why I've been asked to come on, I just want to take again a couple minutes and just briefly give an overview of the program. And then for those of you listening that are interested in getting more information, I'll go ahead and explain the next step at that point. There are 6 commitments we make to every student that becomes a part of the coaching program. The first commitment is to clearly identify goals and objectives. Okay, so the first thing your coach will do is quickly assess where you are now versus where you want to go. You would be amazed at how many investors we work with from all over the world is planned to be created for you. So that's the first commitment. Again, I'm going to go through these fairly quickly. Number 2 is the development and implementation of a strategic trading plan. Now, Gordon just touched on this. For those of you trading that have been struggling in the markets, I invite you to take a look at your system. The system has to provide continuity on a day-to-day process of what you're doing with your trading. It has to incorporate success behaviors that top traders implement, right? Because you're going to have ups and downs. You're going to have good days and bad days. What you want to avoid is a bad year. That's the one you don't want. And the way that you avoid that is by being consistent in your approach to the markets. And the only way you can really become consistent is if you have a consistent system or plan that you're following, right? So the second commitment is, once we've identified what your goals and objectives are, to identify a system that takes you from where you are now to where you want to be. Whether or not you work with a coach, that really needs to become a priority. Number 3, expert enough to coach others. Now, we're not talking about you becoming a coach for us, but rather your own level of proficiency will be such that you could literally coach someone to success the same way we would have done with you. Whether that's a family member or a friend, we believe one of the best measurements of what someone has learned is their ability to share that knowledge with others. Okay, and it really comes down to a great measurement of your proficiency and your confidence. If you can get to a point where you can coach others on how to succeed the same way we would have done with you, that says a lot about your own ability to being successful. Number 4, positive results, right? Making money. Real trading equals real profits with real money. We're not here to make you or anyone else an expert paper trader or an expert demo trader. We're here to ensure that you are making money in the markets consistently. Now, consistency is the key. Makes no sense to make 5% one month and then lose it the next month. All right, and as I stated earlier, if you have a system and a consistent plan, you've now put the odds more in your favor as you go through that. Number 5, a 5th commitment is customization of the entire learning process to you. So during this powerful learning experience, your coach will customize every lesson to your level. So for those of you listening that are either beginners or intermediate or advanced level traders, we'll create a program to accommodate your situation. This is not a cookie cutter approach where one size fits all, and we understand it. Okay, and then finally, number 6, the 6th commitment is cementing the correct habits. I talked about implementing the correct behaviors, right? The correct habits. Your coach will instill or cement the necessary habits for you to become the investor you're saying you want to be. Now, part of cementing the proper habits is fixing any bad habits that might have incurred over the years. You see, habits are the key to consistent success in the markets. We know that. That's why it's important that we make sure that you have a plan or a system in place and that you really learn to follow that system. Okay? So these are the 6 commitments that we make to every student that becomes a part of the coaching program. Now, again, I went through those very quickly. I imagine a lot of you have additional questions in regards to that. If you are serious about making this your best year in trading, we invite you to explore further, find out whether or not coaching is a good fit. So as I mentioned earlier, we are in the process. We have openings that are coming available in the coaching program. I've been conducting interviews for the past week, and the remaining spots we are making available to students who are participating here who would like to get more information on that. You're going to notice a poll appear on your screen. That poll is going to have 3 different options, and that will be coming up here in just a moment. That poll is going to have 3 different options. The first option is yes, please contact me. The second option is maybe, but I need more information first. And the third option is not at this time. So that will be coming up here. While we're waiting for that poll to come up, a couple of things I want to share. As we go through the coaching program, we find that for students, the big gap for a lot of people is not a lack of knowledge, right, or lack of information. When you think about it, we're inundated with information. It really comes down to a lack of understanding on how to use the information you already have access to. The understanding of how to use that information is really what differentiates those that struggle with the markets to those that are constantly profitable. If you think about it, information is just a tool, and a tool is only as good as your understanding on how to use it, like any tool. Right, as you go through that process. If you go down to Home Depot and pick up a skill saw, if you don't know how to use it, it's no good to you, regardless of what it's capable of accomplishing. Well, that's no different with tools in the markets. It's one thing to have them, it's something else to know how to use them to produce results. So again, we have that poll that just showed up. So again, there's 3 options. Go ahead and select one of those. For those of you that select options 1 or 2, you're going to receive a call here in the next day or so from one of our education counselors who will be going through a brief conversation with you and then scheduling an appointment to speak with myself to go into more details on that. Now, in regards to, for those of you that are interested in getting more information on that, bear in mind that this is not a program for those who are dabbling in the markets. Okay, this is not a program for those who are doing this as a hobby. This is a program specifically designed and targeted to those that are looking to do this as a supplement or mainstream of income. So if you feel like you're at a point where perhaps you're kind of needing a little bit more guidance or a little bit more direction or a little bit more clarity on what it is that needs to change to get you from where you are now to where you want to be, or if you're scared about duplicating the past, if you're past trading, if you're worried about duplicating that again and again, and of course we're all creatures of habit, and you're looking to make a significant change in the direction that you've been going, I invite you to take a look, identify whether or not coaching is a good fit as you go through this process. With that being said, I look forward to getting in contact with those of you that are interested in getting more information on the coaching program and working with either Gordon Scott or one of our 5 coaches here. With that being said, I'll hand the time back over to Gordon to close out. And Gordon, when you're ready.
Thank you, Joseph, and thank you, everyone, for attending. I appreciate the opportunity to help you learn a little bit more about how to prepare for crisis investing and the very significant opportunities that are coming up here between now and the end of the year. If you are ready, this can be some of the best trading you will have ever done. Fast-moving markets, to those who have studied the candlestick forum techniques and short-term trading techniques, are oftentimes very profitable endeavors. When the rest of the market's moving really slow, it's great for people that love to buy and hold and do nothing. But for those who are active, well, now's the time to shine. And we hope that you'll be interested in joining us in learning about how to do that. And for between now and the next time we talk, we hope that you will take care and trade well.